Right, no messing about, straight in. Morgan, you've been banging on about this yield curve in the group chat like it's the only chart that matters. My nan talks about interest rates, mate. Sell it to me. Why should anyone listening give a toss about some dusty bond chart when there's real money being made?
Listen to him. Real money. This is exactly why you crypto boys have Lambos 1 minute and are catching the bus the next. The yield curve, my friend, is the grown-ups conversation. It's the market's pulse. Picture a line. That's it. It just shows you the interest rate, the yield the government pays you for lending them money
Right.
from 3 months all the way to 30 years. A chart of interest rates.
Groundbreaking.
Oi, cheeky. Look, in a healthy world, that line slopes up. You lend for longer, you get paid more. Simple. We call that a normal curve.
Okay.
The sun's out, the economy's sweet, but the real intel, the stuff that makes or breaks you, is when the line gets weird. How weird? When it flattens, or worse, when it goes upside down.
Upside down. Like it slopes down.
That's the one. An inverted yield curve. Suddenly, the market is paying you more to borrow your money for 2 years than for 10.
Wow.
That's completely backwards. It's the bond market screaming, I'm terrified at what's coming in the next couple of years.
Okay.
I'd rather lock my cash away for a decade at a rubbish rate than risk it in the short term.
And why does it do that? What's it scared of?
A recession, bruv. The big dogs, the pension funds, the global banks, they smell blood.
Right.
They think the economy is about to tank. And the central banks will have to panic and slash interest rates. So they all stampede into long-term bonds to lock in whatever yield they can before it's gone. That massive demand crushes the long-term yields while the short-term ones are still high. Boom! The curve inverts.
You say that like it's a dead cert. Does it actually work?
Mate, this thing is called every single US recession for the last half century.
Every one.
It's the most reliable harbinger of doom we've got. It's the financial world's equivalent of seeing all the birds suddenly fly away from the coast.
Yeah.
It's the financial world's equivalent of seeing all the birds suddenly fly away from the coast.
Right. But hold up. The curve was inverted deeper than the Mariana Trench in 2022 and 2023. All the stoots on TV were crying about a massive crash.
Yep.
But the S&P hit all-time highs. What happened? Did your magic 8-ball break?
Classic rookie error. Impatience. The curve is a warning shot, not the bullet. It tells you the assassin's in the building,
Okay.
but it doesn't tell you when he's going to pull the trigger. The lag is the killer. It can be anywhere from, 6 to 24 months. And what happens in that lag?
What?
The market rips higher. It's called the sucker's rally for a reason. Convinces everyone the danger is gone right before it pulls the rug.
Okay, fair play. So it's a long-term signal, but is that it? Red light, green light?
Nah. That's the intro. The real alpha, the, CMT level 2 stuff, is in the movement. Is the curve steepening or flattening?
Right.
That's your playbook.
Go on then, Mr. CMT, layman's terms.
A steepening curve is when that gap between long-term and short-term yields gets wider.
Okay.
It's the market breathing a sigh of relief. It's pricing in growth, a bit of inflation, the economy's getting back on its feet. That's your green light for cyclical stocks.
Cyclical's the fun stuff.
The fun stuff. People feel flush. They got jobs, they spending. You look at car manufacturers, airlines, luxury brands, tech hardware.
Yeah.
The companies that thrive when people are splashing cash. That's your steepener trade.
Got it. So a flattener must be the opposite.
Exactly. A flattening curve is when that yield gap shrinks. The party's winding down. It's the market getting cagey about the future. It's the signal to get defensive.
Defensive, as in boring stocks.
As in stocks that keep your money safe, you rotate into defensives. Look, people get sacked. They stop buying iPhones, but they don't stop turning the lights on or taking their prescriptions, and they don't stop buying bog roll.
Right.
So you look at utilities, healthcare, and consumer staples. They're the battle tanks of a portfolio. They'll hold the line while your cyclicals are getting shelled.
Understanding. So the curve's shape literally tells you where to shift your money.
Yeah.
Steepening equals risk on by growth. Flattening equals risk off by boring.
See? You're not as thick as you look. It's an entire sector rotation strategy on one chart. It dictates bank profitability, which lubricates the whole economy.
Right.
A steepening curve is a cash machine for banks. A flat one strangles them. It's all connected. The pros are looking at the term structure, the whole line, and making bets on the curvature, the belly of the thing.
Wow.
They're playing a different game.
All right, I'm sold. It's a proper macro indicator. It's the big money leaving breadcrumbs for us to follow. So, final verdict on the 2023 missed recession. What's the chat?
It's the biggest debate in finance right now. Some argue the signal is now broken because of all the government money printing. But I reckon the playbook still worked. When the curve was inverted, what outperformed? Mega cap tech and defensives. They acted as a safe haven. The signal didn't fail.
Okay.
The nature of the market's reaction just adapted.
A map for a new territory. I like it.
It's the A to Z, mate. Always has been. So next time I drop it in the chat, show a bit of respect for the OG indicator.
Yeah, all right. You've earned it for today. Maybe there is a brain in that head of yours after all. Right, that's us for this week. If you think Morgan is a secret genius or just a glorified weatherman, come and tell us. The link to the Big Shorts Club chat group is down below. Hop in, have a laugh with us, and tell us what you're trading.
Now here's a question we'd like you to think about. With central banks playing games and the economy doing weird things, is the yield curve still the most reliable indicator for a recession, or has its magic finally worn off in this new age of markets?
Is it a crystal ball or a broken clock? Drop your thoughts in the comments. We'll see you in the group. Laters!